Welcome back. We turn 23 tomorrow. And we are ushering in our birthday celebrations today with someone who is a tad older than us in the markets, but who has been with us for the better part and who, like us, believes the market is our best teacher. Welcome, Vetri Subramanian, the Chief Investment Officer at UTI Asset Management Company. Vetri, thank you very much for joining us on the eve of the celebration. We are kicking off our celebrations now. Since you've observed the market for almost 3 decades now, does it look like the Indian investor, the Indian saver, has definitely become an investor? Is that one of the big paradigm shifts, if you please, of the last couple of years?
Yeah, thanks, Lata. That's a very interesting question. And first of all, delighted to be here. I think the first time I appeared on your channel was precisely 24 years ago. Oh. So it's wonderful to have been part of the journey with CNBC TV 18. I think, certainly there is a big story in terms of the fact that I think the sheer size and numbers that we are seeing in terms of the growth of the Indian investor base is something quite remarkable. I remember going back to, the late 98, 99, when I used to be on the broking side, on the retail broking side. In fact, it was a very disappointing period because, the number of active investors weren't really going up. And I would say that's a story which sort of stayed unchanged for almost 10 to 15 years. And it's only during the previous decade, sometime in the middle of the last decade, where we suddenly saw the number of active investors, be it whether you look at the mutual fund route or you look at the unique number of demat accounts, these numbers really started to take off. And, that is why I think the whole, discussion around financialization of savings, we've always known that the Indian investor has saved, but the preferred avenues were gold and property, but they have now started to divert a lot more of their money into financial assets, and particularly the mutual funds and stocks directly. And I think that's helping to broad base the market, and it also helps create a pool of long-term capital because for entrepreneurship to flourish, you don't not only need good entrepreneurs, but you also need a large pool of capital. So I think the equation is looking a lot more balanced today than it was 20 years ago.
Now, there's a reason why I brought that as a paradigm shift. One of the oft-repeated complaints about India's all-time high record at this point is that valuations are too high. Are we likely to remain that way simply because there is a huge domestic pool that's coming by?
That's not a very appealing argument for me, okay. Lata. What I've learned the hard way over 30 years is that valuations do mean revert. There are times where they will trade significantly above the average, but they will find reasons at some point to once again trade below the average. Now, that may be too extreme a approach to use as an investment policy, which is to only wait for extremes to either reduce or add equities. But, at least we'd like equities to trade back into what we call sort of a fair value zone. By the way, as recently as, June, July of this year, we were actually in the fair value zone, but with the push-up which has happened in India as well as with global markets over the last few months, we've again pushed back into rich territory. So I don't think there is anything such as, trading at a permanently high plateau, okay. In terms of valuations. And I'll also make another point here, Lata. It's useful to not just look at valuations of equities relative to history, meaning we look at where the PE is, we look at where the price to book is, maybe where the dividend yield is relative to history, but it's also useful always to look at where do equities trade relative to a very simple asset class, which is, say, bonds. And today, when we compare the 10-year bond to equities, actually the needle is shifting in favor of bonds rather than equities, So from that point of view, I would actually say that right now it's the bonds which are looking reasonably attractive, particularly high quality bonds. You aren't actually getting rewarded for taking any level of credit risk. The credit premiums are too small, but high quality bonds, including sovereigns, certainly a very attractive trade just based on the historical relationship of bonds versus equities.
Oh, then you wear your CIO hat and tell us, is the immediate choice fund balance advantage?
Certainly, I think the whole range of hybrid schemes are far more interesting at this point of time because you are getting the potential of much better yield on the debt side of your portfolio. I think most investors today perhaps still look at what their bank is offering them on one-year deposits, but the banks haven't actually opened up that rate as much. And in fact, they are borrowing in the CD market at much higher rates than that. So, you could buy a reasonably high quality mutual fund portfolio with a duration of less than 2 years, which is sitting at yields, portfolio yields. So the net yield would be lower, but the portfolio yields could be as high as 740, 750. So, to my mind, that is an attractive opportunity for investors, not just the hybrid option, but equally even the fixed income products with, up to 2-year, 10-year, 7.5% is attractive.
Okay. Well, I wanted to come to sectors in just a bit, but my producer is showing all the key holdings in your FlexiCap fund. So I'll come to it very quickly. First up, are you expecting the coming years to be, next couple of years, where we have some visibility, to be very good earnings growth years? We saw, I think, a 40% Nifty EPS growth in FY23, in FY22. FY23 has been more sober. I see estimates ranging between 10 and 12%. Will 24 be much better? So is equities continuing to be a good bet?
So good question, Lata. I think, if I look at the direction of earnings growth revisions, they've been to the downside, right? So if you go back a few months, the Nifty 50 earnings growth for 23 was perhaps closer to 17, 18%. That number for FY23 has now dropped to about 12%. If I look at the 24 number, the earnings growth was forecast at one point to be higher than 20%. That is also now dropping and coming down to about 18, 19%. So the direction of earnings cuts seems to be to the downside at this point of time. And I would, therefore have some concerns about valuations and the potential for further earnings cuts. There is also another, I think, issue we need to think through a little bit more clearly, Lata. I think there's too much discussion. Obviously, you have the RBI policy tomorrow. I'm sure you're going to spend a lot of time discussing that. But I don't think the issue is anymore limited to what does the RBI do. I think what's happening in the marketplace in terms of cost of capital is actually far more interesting because we've got credit growth running at 17, 18%, yes. Deposit growth, for some of the reasons I mentioned earlier, running much slower. And you've got an economy which is now going to be looking for where do we get capital to grow from. And if this starts to pull the rates higher in the market, forget what the RBI does. They'll do 30 basis points, 40 basis points. But I am a bit concerned about India's ability at this point of time to fund the growth for next year because the situation in terms of liquidity in the system is looking tight. And if that causes rates to move up in the market, that could be something which could, eventually come back to hurt equities as well.
Okay. I was going to ask you whether you're going to bet on capex stocks next year. You've kind of partly answered it. I mean, that question was mainly because in your list of stocks in FlexiCap, L&T holds a prime position. Now, we all know that this is the finance sector, the financial sector, or rather the banking sector has been the winner in the current year, in 2022. What would be the next best sector for you? I mean, even you are heavily invested in finance stocks, in banking stocks. What is the next best sector?
Very difficult one today, Lata. I'd say if I look at the last 1 year, the areas that we've liked, automobiles going back a year ago, it's done well. Valuations have now put up more to sort of mid-cycle. Same for financials. We were very positive a year ago. But again, over there, valuations have moved up. And, we're glad to see those prices do well and therefore pull those valuations up. So there isn't really too much in that sense, which is now looking attractive. If I just step back for a moment, Lata, let me describe the problem. The problem is when you take a top-down view on India and the stuff which is domestically related, you can feel sanguine about the growth outlook. but you are already paying a very high valuation for that. You know, we can discuss whether it is just moderately expensive or extremely expensive, but anything to do with domestic is now getting priced very, very fine. Now that becomes difficult if you are to make incremental money or extract alpha from it. So, you know, really from my point of view, if I had to go and look for where are the pockets of the market where actually the top down is negative, but perhaps in some cases the valuations have now moved in favor of the value seeking investor, then you are more likely to find it in cyclicals which have more of a global exposure rather than the local exposure, right? So if the US recession turns out to be shallow, you know, stocks which are exposed to business outcomes in the US could, you know, actually surprise. If China starts to back away from zero COVID, as we've seen in recent days, and starts to sort of look at their economy more constructively, that could again be a positive surprise. Because remember, the consensus discounted in those sectors which are exposed to these areas is very, very negative. So really it's a question of, is something going to improve for the better, or is something which is likely very well placed, but if it's already priced for perfection, then you have really no, you know, short-term advantage, so to speak, over there.
Okay. I've been warned that I'm out of time. I'm going to try and get a one-line answer from you. Can the balance shift to mid and small cap? They are the guys who have underperformed.
Not on our valuation metrics, Lata. I think the large caps look the best placed. Mid caps, I would say, sort of in the same territory. The small caps are something where we think valuations are still not favorably placed.
Oh, that's a most useful conversation. Thank you very much, Vetri Subramaniam, for being part of our 23 years and our 23rd year celebrations as well. Have a great one ahead. We have to wrap up on Bazaar. Chartbusters up next.